Well, good afternoon, everyone. Welcome to the webinar, Best Practices, Appraisal Reviews, and Compliance. My name is Steve Albert, and I'm the Executive Vice President with Allstate Appraisal, the national AMC headquartered in Illinois. We very much appreciate you all calling in today. There's a very large group signed up for this webinar today, and we recognize everybody has obligations above and beyond just this, so we've limited this to a 30-minute webinar. We completely realize that 30 minutes is not adequate time to cover such broad topics as compliance and review, so we're focusing on highlighting just those front and center issues right now that seem to be on everyone's tip of their tongue. Any questions that you may have today, as most of you have had occasion to participate in webinars in the past, you can type into this box. We'll respond to whatever questions we have time to after about 20 minutes. Other questions that we can't get to today, we're going to respond to in an email that we'll submit to all attendees today, so make them good. With me here today is Scott Sparks, who's our National Chief Appraiser. He'll be doing most of the heavy lifting, and I'll be doing the introduction and getting the ball rolling. Just to establish some basic credibility as to how we're qualified to even conduct a webinar. I know a lot of the names on this list of attendees are people that I know, a lot of names I'm not familiar with, but a lot of smart people on the phone today, and Scott and I are very much aware if we say something stupid, we're going to hear from quite a few people reminding us. So we're going to do our best. But Allstate's been a long-time participant in the valuation space, starting the company in 1959. And in 1991, we began performing reviews, primarily for lenders. They were mostly pre-funding and post-funding reviews, but ultimately that work expanded to include the GSEs and mortgage insurance companies and law firms. And then by 1999, we expanded our service territory to include all 50 states. And for many of you in the industry at that time, which is probably a good portion of the attendees on this call, in 1999 there may have been 10, 15 AMCs. I'm not sure the specific number, but there wasn't that many. Today, if the numbers are accurate that we've all been reading about in certain networking groups, there's upwards of 500. I've heard as many as 560 AMCs, or companies identifying themselves as AMCs in the space today. And there's no question that that 560 number, a very substantial number, are still really appraisal firms who've had to recategorize the company type due to regulatory requirements. In other words, appraisal firms conducting themselves as they've always conducted themselves, assigning orders to subcontractors, may not identify as appraisal firms in their respective states and instead have to register as an AMC. So the number's a little misleading, but the reality is that there's a lot of participants in the industry today. And I think it's harder than ever for lenders to be able to ascertain which AMCs to align themselves with in order to minimize their risk and make the most effective use of quality control protocol. In 2008, we expanded our service territory to include commercial work and review as well, and that has allowed us to have some unique perspective above and beyond just residential. But today's phone call is geared primarily to residential. The last portion of this timeline was at the urging of Scott Sparks to include, as he would explain to me, this is the most important milestone in our company's 54-year history, was him joining our team. And Scott will be speaking very soon. So to get started, what are realistic quality control expectations of your third-party vendors? And when I say third-party vendors, I'm relying primarily on AMCs to conduct that service for lenders. And some lenders who don't use AMCs will still outsource their work to companies providing reviews. What are realistic expectations? In our opinion, we think a good starting point would be for lenders to give consideration to firms that have had occasion to provide appraisals and reviews for as many components of the lending arena as possible. Not just lending institutions, but the mortgage insurance companies, maybe for mortgage insurance claims investigations, of course for the GSEs, for the repurchase demand challenges, for servicers, obviously, REO appraisals, FDIC and law firms, the #1 litigants or litigators against appraisers today, they order appraisals and appraisal reviews to ascertain if failed banks' assets may have failed in part due to improper or inaccurate appraisals. Title companies rely upon appraisal firms across the country to assist them in alleged title insurance claims policies to help ascertain if an alleged title policy error may have had an impact on a property's value or marketability. So as a starting point, we think it's important that consideration be given to a firm's varied experience. Without further ado, however, I want to introduce Scott Sparks, who spent the last 15 years specifically in the lending arena in the quality control division specifically, most recently with a major lender as their National Chief Appraiser. Scott's primary responsibilities were for mitigating risk of the lending institution's lending platforms by selecting the most qualified third-party companies, auditing what they did specifically and how they did it, how they do it specifically for those lending institutions, and then mitigating risk through the application of vendor management. Scott, take it from here.
Great. Good afternoon, everyone. I appreciate you guys calling in today. Want to start out first just going over there's a couple key things that we're going to go over today. First, what should you expect from your AMC? What should they be doing to protect you, the lender? And then second, one of the more major topics right now is third-party oversight. What should you, the lender, be doing to make sure that your AMCs are doing what they say they're doing? I know compliance and regulatory changes are happening every day. I wouldn't be surprised if many of you don't have an ongoing audit happening right now that you're having to pull yourself away from. But we're going to go over those couple points today, discuss them briefly, and then obviously try to answer any questions we possibly can. So first we're just going to jump into what the 2010 Interagency Appraisal and Evaluation Guidelines state. First they say an institution that engages a third party to perform certain collateral valuation functions on its behalf is responsible for understanding, managing the risk associated with the arrangements. It goes on to say an institution should have internal controls for identifying, monitoring, and managing the risk associated with using a third-party arrangement for valuation services, including compliance, legal, reputational, and operational risk. And then with the safe and sound practices, an institution should have a written contract that clearly defines the expectations and obligations of both the financial institution and the third party, including that the third party will perform its services in compliance with the agency's appraisal regulations and consistent with supervisory guidance. I know many of you guys, and Steve mentioned that there's over 500 AMCs out there. I know back when I was with my last employer at that large lender that I was at, I probably heard from all 500, if not more than 500 AMCs, with most of them multiple times. I can tell you that what I was looking for as a chief appraiser, when somebody would call me, how did they start out? Did they start out saying how quickly they do things, how cheaply they do things? Those are things that to me were buttons that said, hey, you know what, I probably am not going to go down that road. I probably don't want to work with this company. Now, if somebody, an AMC, would call me and say, hey, we want your business, and here's what we do from a quality control standpoint. Here's what we do from the time we receive the order. Here's what we do all the way through the loan process or the appraisal process until the time we deliver it, and then even times after that, after they deliver it. What are they doing to help you with additional information that's needed on your appraisal to make it qualify for your investors? So we're going to first touch on how much review is enough. You know, what should your AMCs be doing? The lender should require a report that's compliant with USPAP. It complies with your agency's appraisal regulations, and it's consistent with supervisory guidance. So the first thing is to know exactly what your AMC's QC policy is. What do they do from the time that you send them an order all the way through the time they deliver it to you? And then even after that, what are they doing when you ask for additional information? So my first question would be, hey, you know, how do you select your appraisers? Once you select your appraiser, once that appraisal is delivered to you, who do you have reviewing those appraisals? How are you making sure that that appraisal that you're delivering to a particular lender is going to protect that lender from possible losses in the future? That's the key right there, to make sure that the AMC that you work with is following appraisal independence guidelines, and then it's providing you with a quality report that's going to protect the bank from future losses, and that you can make a good lending decision on. At the end of the day, that lending decision is a lot based on the appraisal that you have provided so that you can make an accurate and credible decision. And then know the qualification of the reviewers. What kind of reviewers do they have? I would recommend that they use licensed appraisers. They possibly could be using some old processors or those with underwriting experience, and they're training them to do certain aspects of reviewing appraisal. Are they looking through it to make sure there's consistencies within the report? Does the square footage read the same all the way from page 1 all the way through the end? Is there pictures? Are there locations maps? All those things are very important, but is that person qualified to read an appraisal and say, hey, this appraiser did a really good job? and that's where we get into the depth of the review. What should you expect your AMC's QC division to do when they're looking at it? Should it be a checklist, or should it be much deeper than that? I would say the depth of review should be sufficient to ensure the methods, assumptions, the data, sources, and conclusions are reasonable, well supported, and appropriate for the transaction that they're looking at. This is best performed by an experienced appraiser, in my opinion, because while it is very important, and I'm not sure that any AMC doesn't use a checklist to some degree to help them guide themselves through an appraisal report, to make sure that the square footage is consistent, to make sure that the address matches the USPS, to make sure that the correct photos are there, to make sure that the appraiser labeled the location map. Things of that nature are all important. But I can tell you back when I was defending repurchases and fighting in my rescissions at times, the depth of the report, what the appraiser did to support their conclusions, the rationale for the final development of value, those were the things that were most important. And in my opinion, it's going to take somebody who's experienced, most likely a licensed appraiser. They can pick that report up. They can read it from page 1 all the way through. They're going to read the addendums of the report. They're going to look at why the appraiser told you he took this comp or he chose this comp, and then I'll look at the final reconciliation. How did that appraiser develop their opinion of value? Those are the important things. Those are the things that when you get a repurchase or you get in my rescission that you're going to have to defend. So on the front end, the AMC should be looking to make sure those things are there. Did the appraiser provide sufficient enough data, sufficient enough commentary within the appraisal that's going to help that lender be able to defend their position on why they did what they did? It also, if you're using a licensed appraiser to do the review, it allows them, when they're reviewing the appraisal, if there's something missing or maybe something that doesn't add up right in that review, they can actually pick up the phone, call the appraiser, and say, hey, I'm going through your report here. I know you used a couple comps that maybe don't fit within typical agency guidelines. Maybe the net and gross adjustments are exceeded. Maybe a comp is over a man-made border. But I don't see any comments in here. Is there any way that you can put a few comments in here? Tell me why you chose that comp. Tell me why some of the adjustments are a little excessive. Those are the things that are going to save you, and it could help the fact that an AMC is using a licensed appraiser. Typically, appraisers are more receptive in receiving a phone call from another licensed appraiser questioning their work than they would be from somebody who's not licensed, and that could help with timeliness. And that brings us to our next thing, is the timeliness. I understand, and certainly the pressures that lenders are under to get an appraisal back as quickly as possible, especially with TILA and some of the high-priced mortgage loan regulations that are coming due in January of 2014. They're going to require the lenders to provide that appraisal report to their borrower 3 days prior to close. So it's important for you guys to have a timely appraisal report. The one thing that you want to make sure is that you're not sacrificing quality. At the end of the day, you're going to hope that your agency is sufficiently staffed to review whatever amount of orders they have coming in as quickly as possible, so that they can look through their appraisal report, make sure that it's a good quality report. If not, go back quickly to the appraiser, get those things that are missing, and get that delivered to the lender as quickly as possible, so that you guys can make a credible lending decision. And that brings us up to what should they be doing from step 1 to the end before delivering? What is a checkbox review enough? And again, like I mentioned before, I'm not saying checkboxes aren't good. It certainly helps you guide yourself through the appraisal review process. But if it's only checking for consistency through the report, or checking to make sure photos are there, or checking to see if the location maps and things like that, those things are important. Most of those things today are being caught in UAD and UCDP. They're making sure the USPS and adjustments and mileage and things like that are properly checked. But it's going to take experience and somebody to able to analyze it. They can pick up that appraisal report, read through the comment section, understand why the appraiser chose the comps that they chose, understand why the appraiser came in at a certain value point, whether that's at the lower end of the value range or the higher end of the value range. The appraiser actually did a very good job of explaining why they did what they did. Those are the things that we should be looking at, and you should be asking your AMCs to do for you. So your reviewer should be capable of assessing whether or not the appraisal contains sufficient information and analysis to support those value conclusions. That's very important. Again, we have to be careful. In today's world, the states are beginning to regulate who can look at your appraisals, and where they can look at them at. So you want to make sure they're doing standard 3 reviews, which means they're not going to be able to find a value, but they can certainly read through the appraisal and say, hey, this appraiser did a good job, or this appraiser hasn't done enough. And they're going to go back to that appraiser and say, hey, if something's missing, can you just give me some more documentation? Can you give me some more data? Can you give me some more comps? Any of those things that can help make that appraisal credible. That's exactly what they should be looking for. When they're looking at an appraisal, they should be asking 4 key questions. Does the appraisal comply with use path? And that's a big thing. And I can tell you, in my time fighting repurchases, if they were to find a use path, an appraisal that was not use path compliant, such as an appraiser failed to note a prior sale of the subject within the last 3 years, if they were to get a field review 2 or 3 years down the road, and they found out that the original appraiser failed to mention a prior sale, it was an automatic loss. So if they could prove that that appraiser did not provide a use path compliant report, it's an automatic loss, we couldn't defend it. So you want to make sure that your QCers for your AMC are able to verify that it's use path compliant. Second of all, the AMC should help ensure compliance with the regulatory guidelines and regulations. I know when I was working at the lender I worked for, we developed our appraisal policies and procedures, our collateral guidelines, around what our agencies, what our investors required. We would write that. We would deliver that to the AMC. We would actually assist the AMC in writing an engagement letter specific to that lender's requirements, so that when they gave that assignment to the appraiser, they knew exactly what they needed to do in order to deliver that appraiser back to the lender, so the lender was satisfying any of their agency and regulatory requirements. And then also, does the information and procedures in the report appear valid? Again, that's going to take somebody that can pick up the report, not only verify and make sure it's consistent data, but to make sure the appraiser did a good job of explaining why they did what they did and how they came up with their value. And then number 4, it's the most important point. It's the one that helped me defend several repurchases and MI rescissions down the road. It was, does the final value make sense? Again, when you're looking at the appraisal, you're looking at the comparable sales, you're reading the addendums. All those things are so important when it comes to defending an appraisal, if need be, and protecting the lender. At the end of the day, the AMC should be writing you a quality report that's going to make sure the lender doesn't lose money in the long run. So now we talk about what are the lender's responsibility, the third-party oversight. So when you're using a third-party vendor in this situation, AMCs, what should you be doing? I can tell you, the lender that I work for, any AMC that we work for, we did an automatic 2 times a year, an on-site audit. I would, and again, that could differ depending on the size of the institution, but I would strongly encourage that any AMC that you use, you go out there once a year. What we would do is we would show up 100 files. We would sit down in an office and we would say, okay, we brought these 100 files. We're going to make sure you're doing exactly what you told us you were going to do. First, we would say, okay, how did you select your appraiser? Is appraiser independence being met? Okay, did you choose the best quality appraiser? Did you choose an appraiser who's going to get it done quickly and inexpensively, or did you choose the most qualified appraiser? And that's the important piece, to make sure that you're using an appraiser that's qualified. And that's why each one of your AMCs should have to prove that they have a scoring system. Are they scorecarding their appraisers? Are they dinging the appraisers for not providing good quality reports? Are they dinging appraisers for not providing reports within a timely fashion, the SLAs that are stated? Those are the things that you should ask for. You should say, show me why you chose this appraiser as opposed to the other 15. Number 2, we talk about reasonable customer fees. I know this has been a hot topic, and I'm sure the CFPB is asking around right now how you're ensuring that your AMCs are paying a reasonable customer fee. And again, that's on the lender. And that you're going to be the one that's questioned. The lender I work for, we actually established our own reasonable customer fees. We told the AMCs you were going to pay the appraiser this, and then we were going to pay them for their duties on top of that. So for whatever things they did. So it was a cost-plus type situation. But regardless of whatever assumption that you chose at that time, you need to make sure that the appraisers are being paid a reasonable customer fee. And then third, and most importantly, I wanted to see their quality control efforts. I wanted to see exactly how I knew that somebody was picking up that appraisal, was reading it from page 1 all the way to the end of the document to make sure all the photos were there and all that stuff, which is great, but to also find out how did they tell me that this was a good appraisal? How do I know that they thought this was a good appraisal when they delivered it? And I can tell you when we first started doing audits, I would say out of the 100 files, only about 20 of them had QC notes in it. And those were the ones where they were going back to the appraiser and they were saying, hey, why did you choose a comp that was over 2 miles, or you forgot to note a flood cert, or something along those lines. The other 80, I said, where are your notes? And they said, well, we don't have any notes. They were good appraisals, so we just sent them on. And I said, well, that's not acceptable because I really have no idea that you picked this appraisal up. I need you to always comment, provide me with some commentary within the appraisal report that shows that you did your due diligence. So what I would ask them is what we moved on is providing a cover letter. We asked them to provide a cover letter that says, hey, these are the things that we saw in the appraisal report that might be red flags for the lender, that might be an agency requirement. If there were comps that were over 6 months in a declining market, did the appraiser provide some commentary? Did the appraiser talk about why the 15 and 25% net and gross adjustments were exceeded on a particular comp? Not that it's not a good comp, but did the appraiser explain it? So what we ended up doing was asking our AMCs, give me a letter stating what you did from a QC standpoint and tell me why you're okay with it. So if we saw something like that, the AMC would say, hey, comp number 2's got net and gross adjustments over 15, 25%, but yet the appraiser addresses it within the addendum on page 7. So when we finally deliver that appraisal report, the underwriting at the lender would pick it up and say, hey, look, this AMC's already talked to the appraiser, or the appraiser already identified within the appraisal report why they did what they did. That was unbelievable. It certainly helped clear it. It actually made underwriting of the appraisal much quicker in the lending because you weren't going back to the AMC for something that they've already addressed with the appraiser. So moving forward, I guess the main point here is lenders should never overlook the importance of a strong, verifiable QC process provided by their third-party vendors. This truly is the key to minimizing investor repurchase and MI rescission challenges. That's all I have. Those are, again, two main topics, the third-party oversight and what your expectations should be of your AMC. Now I guess we'll open it up to questions from the audience.
And Scott, I've got a bunch of questions here, and I'm not going to have a chance to get to all of them in the time that we have allotted. We will respond to every single question, and we'll follow up in an email to all those participating with what we hope to be reasonable and sensible answers. Here's the first question, Scott. When you're auditing AMCs, when you were with the lending institution, did you alert the AMCs to what files you intended to audit beforehand, and how many files would you audit?
Yeah, we brought 100 files, and we would not tell them. Obviously, we would set up dates for them. We would show up. We would sit in an office. We'd pull up 100 files. We'd all sit in a room. We would make them show, number one, like I said, why they selected the particular appraiser that they selected. And then number two, did they pay that reasonable customary fee? And then most importantly, you know, that quality control piece. What did they do to ensure that they were delivering a high-quality appraisal to myself that was going to protect the lender? So to answer your question, about 100 files, and no, they had no idea which files we were going to audit.
Okay, thank you. Number two, what are the most important things to review in an appraisal when trying to avoid the possibility of a repurchase demand, was the word used, down the road?
Yeah, and those are important things. I can tell you just from my past experiences, again, we talked about USPAP violations. If there's a USPAP violation, it's an automatic loss for a lender. It's just not defendable. The other thing that wasn't defendable was the exclusionary list. If Freddie Mac obviously has their own exclusionary list, that it's the responsibility of the lender to provide those names to the AMC, obviously, because the AMCs don't have access to the Freddie Mac list. But if you used an appraiser on the Freddie Mac exclusionary list, again, it was another automatic loss. It didn't matter if the value was right or wrong. But most importantly, what we had the best in luck with, or sometimes the worst luck with, was that what we talked about was the commentary by the appraiser. Did the appraiser provide sufficient enough data within their appraisal report, enough commentary in their appraisal report to support why they did what they did, why they chose the comps that they chose, and more importantly, how did they derive that final value? Did the appraiser do a final reconciliation, which, to be honest, was missing quite a bit. It still is today in many areas, but prior to 2007, appraisers got lazy and didn't explain how they came up with adjustments. So that final reconciliation, that support for why the appraiser did what they did, that's the most important thing to review, because that will help you defend a repurchase or an MI rescission down the road if needed.
Okay. This is a common question that we hear from not just banks that we call on to hopefully do some business with, but reviewers that we look to hire when they're looking to us with regard to our expectations of them for daily production and their quality control. So the question is, how many reviews per day should an AMC's staff quality control team conduct? I think what they mean is how many reviews per day should a reviewer reasonably complete?
Yeah, and that's a tough question. Obviously, the complexity of every assignment differ. You've got some that are tract subdivisions where the review is a lot easier. You look at it, all the counts are within a quarter of a mile. Very similar bedroom count, very similar bath counts, required few adjustments. Those things, obviously, nothing can be done in seconds or even a few minutes. But those might only be a 15 to 20-minute review. You're looking through the photos, you're reading the commentary. The appraiser doesn't have a whole lot to say because everything's within the same subdivision, very few adjustments and things like that. But the more complex the assignment on those unique properties, where it doesn't fit into that square box, you had to go outside the bounds. Is what did the appraiser do? What did the appraiser say? How did he develop his opinion? How did he support his comp selection? And those could take a reviewer, up to 45 minutes to an hour to review, if not longer. So I don't know if that number is good to say they should look at a particular number. What I'm saying is the easier the assignment, and when I say easy, it's one of those easy reports to read because everything is it's the same all the way through. The comps are very similar. Those are 15 to 20-minute reviews. More complex reviews could take 45 minutes to an hour. So it could vary.
It just depends.
Yeah.
Here's a question. It's a little lengthy. I'm going to be scrolling down as I'm reading it. Is the institution exempt in any way from managing the approved appraiser list per the regulatory guidelines outlined if loans are sold to the secondary mortgage market?
So what was the first part of the question again?
Well, it just says, the question was, is the institution exempt in any way from managing the approved appraiser list per the regulatory guidelines if the loans are sold to the secondary mortgage market?
Yeah, they are exempt. It's up to the AMC to use it. The only thing that they wouldn't be exempt from is that exclusionary list. If somebody's providing you with an exclusionary list that says you can't use these appraisers, then it's the lender's responsibility to make sure the AMC is using the most qualified appraisers. If you don't provide them somebody on their E-list, then they wouldn't know. But it is your responsibility to pass on appraisers that they cannot work with.
Okay. We've got time for probably just one or two more quick questions. We have 2 to 3 minutes left here. Here's a question. When we have the opinion that the report is unacceptable or materially deficient, but it is not black and white non-compliant with USPAP, we don't want to pay for the report or charge the borrower. AMCs want to be paid for the work that they have done. Is there any clear expectation or direction around this situation in the industry? So I'm going to try to restate this question as I understand it. And again, if we've lost something in translation, we're going to double back and send everybody a response to the best of our ability. If the lender or institution feels that the appraisal was not adequate, are they legally obligated to pay the AMC and the AMC the appraiser if the report doesn't meet USPAP or other regulatory and industry guidelines?
And that's a tough question. Obviously, if it's USPAP errors, I would say if you could prove that the appraiser is not following USPAP and has some clear USPAP violations, then you could talk with your AMC about paying that appraisal. If it's black and white, certainly you got to pay the appraiser because, again, the state boards now have really dived deep into every state, and they are protecting the appraisers to a certain degree. And again, it's not a bad thing because appraisers many times in the past were unprotected entities, but now they need to be protected to a certain degree. But if it's clear USPAP violations or that appraiser is providing a poor quality appraisal, then I think that's when the discussion of should that appraiser be paid or not. But that's up to each institution and every AMC to determine when they think it's appropriate to pay an appraiser. And I would say, again, if it's gray, pay the appraiser. If it's clear, black and white that they've committed use PAT violations, then I'd say no. Then it's not the responsibility to pay the appraiser because they didn't do the job they were hired to do.
Okay, I think we have time for one last question. How do you, as an AMC, handle mandatory reporting for non-compliant appraisal reports?
So how do we handle non-compliant appraisal reports? What do? We report every finding that we have where an appraisal is not compliant. We're reporting to the state boards as we're required to do. We're taking those, anything that has use PAT violations, anything that's unsupported, we're taking it to the state boards. We're notifying them of an appraisal that we have, that an appraisal was non-compliant.
Okay. We are at 2:30. We want to be honest to our 30-minute time slot here. We appreciate everybody calling in. We hope that there's been at least a couple of things gleaned from this presentation. And again, we thank you for taking your time. We will follow up, send everybody a connection to the slides. You'll receive an email to this presentation itself, as well as an email addressing unanswered questions that we didn't get around to answering today. So everybody have a great rest of the week. We'll see you all soon at upcoming conferences. Thank you very much. Scott, thank you very much.
Thanks.